Hi everyone, welcome to today's video. So take a look at this particular chart. It is of Nestle PE ratio, and what you would observe is that Nestle was trading at a PE of roughly 50 back in 2010. Then it continued to hover around that mark, and then over the years the PE has generally gone up, and now Nestle is trading at a PE of 89.90. Now the reason why I'm telling you this story is fairly simple, because back in 2010, if you would have looked at the PE of Nestle, you would have said 50 PE. Who is going to buy? Mad people will buy it. It's an overvalued stock. Let me just discard it, because I have learned that if PE is less than 30, go buy a stock. If PE is more than 30, it's overvalued, don't buy it. But let us take a look at the stock price growth of Nestle. So in 2010, Nestle was trading at roughly 2600, and now it is trading at roughly 18,000. Now there is almost a 7-time growth in the stock, despite it having a very high PE right from 2010 onwards. Now why am I telling you this story? Because I get so many comments that Akshat, this stock is overvalued because the PE is so high. If you go and buy it, you will just ruin your financial well-being. Or Akshat, you know what? Coal India is trading at a PE of 6 and 7. I should just literally jump on that stock because it has such a great PE. So on this video, I am going to help you demystify this entire concept of PE and what is it that you must do in order to understand what undervalued stocks are and where not this PE ratio is sensible to use. Super interesting video. Do watch it till the very end and also press the like button so that helps this video get out to more people and make them more aware about the stock markets. Also, I would like to thank our knowledge partners for today, which is Ditto. I absolutely love their product. They are an excellent platform in terms of buying health insurance and life insurance. I have personally purchased my insurance and my family members have also purchased insurance from Ditto. You can go and speak with insurance experts for free in terms of availing the right insurance for you. Also, because the tax filing season is in progress, you can save some money by buying insurance. So speak with Ditto expert. They can help you explain about this aspect as well. So do check the links in the description box and schedule your free phone call today. So first and foremost, let me help you demystify and understand what is the exact meaning and interpretation of a PE ratio. So PE ratio formula says that PE means price of the stock divided by earning per share. Now, how do you calculate the price of the stock or earning per share? You don't need to use math there. Basically, PE ratio is always given to you. So you can just simply go on any screener and you can identify the PE ratio of the stock itself. So you don't need to run a mathematical model to figure out the PE ratio on your own. What is important for you as an investor is to understand what is the meaning behind PE ratio. Let me clarify this point by giving you two specific examples. So example number one will be of Nestle, as I showed you that the Nestle PE is roughly around 89.90. So what does that mean? It simply means this, and this is the important statement, that in order to make 1 rupee from Nestle stock, you have to invest 89 rupees, right? So that is what a PE of 89 indicates. Coal India has a PE ratio of 7. So what does this indicate? It indicates that in order to make 1 rupees from Coal India, you have to invest 7 rupee as an investor at the current prices. So this is what the formula interprets to, and this is the easiest explanation that you might find anywhere. Now you would say, okay, this looks like so obvious. Why would I ever go to a stock like Nestle when I'm getting something like Coal India at 7 rupees? I will just invest my money there because I just have to invest less in order to make that same 1 rupee. Here I have to invest 89 rupees to make that same 1 rupee. So only a mad person will go and invest in something like Nestle. But here is the fundamental problem with that theory. You and I as investor, we are interested in the future prices of the stock, not the current price per se. For example, if you and I buy Nestle today, we are buying it with the expectation that the Nestle stock will go up in the future. Similarly, if we are buying a low PE stock also, again, we are buying it with the expectation that this stock will also go up in the future. So we are more worried about the future. So what is it that we are bothered about? We are bothered about the price growth, not necessarily the current PE of the stock. So what is it that can be inferred out of a high PE stock? For example, when we say that Nestle is trading at a PE of 90, why would some crazy person go and buy it? Simply because of this equation. One is that people expect that the earning per share will go up in the future, and as a result, the entire PE will come down. So even buying a high price share might be a sensible move. So when you see a stock with a very high PE, there are two fundamental explanations for it. One is that the stock can actually be overvalued, that there are no growth prospects in it and the stock is highly inflated, highly overvalued. That is one key interpretation, and under such circumstances you should avoid buying such stocks. But the second explanation could be that the growth prospects of that stock or of that industry might be really, really high, and it might make sense to buy that stock even when the PE is quoting to be very, very high. That is the same reason why Nestle, despite having a very high PE in 2010, it has continued to grow. Even its PE is growing right now, and the company is expected to grow as well. On the flip side, let me talk about low PE and low growth company. Should you just simply go and buy a company because its PE is low? So a classic case here will be Coal India. So if you take a look at the stock PE of Coal India, you will see 7. Oh, it's just like super inexpensive. Let me just go and buy it. Why? Take a look at this. So for example, you can see that even since 2010, the PE of this stock has been trading low. Anything less than 30 is considered to be, traditionally speaking, a low PE stock. So it has always traded somewhat less than 30. In fact, its PE fell to all the way to 9 or 10 here, and then it climbed up, climbed down, this, that. And now it is roughly trading at 7. Buying such a stock at any level would have made sense if this stock would have generated wealth for its stockholders. So let's look at the stock returns from 2011. So you can see it was trading at 320. It went max to 439, and now it is trading unfortunately at 167. So in summary, you need to remember these two key points. One, that high PE plus high growth companies are not necessarily bad. For example, Nestle, it can have a high PE, but as long as its growth stays active, as long as it keeps on giving more and more returns, there is no problem in buying such companies even at high PE. On the flip side, point number 2 is that there are companies with very low PE and very low growth potential. Please don't go and buy such companies, because even if you buy them at a PE of 7, that PE can fall to even 2 or 3. So now the obvious question will come that, okay, does it mean that PE ratios are pretty much pointless? The answer is yes, they are pretty much pointless in my opinion, but there are two key things that you must remember which make PE ratio somewhat useful. The first key thing is that PE is a very good measure if you are doing relative comparison between similar stocks from the same industry. A classic case in point would be the IT industry. For example, if you are looking to compare something like TCS with Infosys or Wipro, it might make sense to get an estimate of what the PE of these three stocks are. If you find some odd figure, for example, if you find that TCS PE is trading at 65, hypothetically speaking, and Infosys at 23, then you must do further analysis to identify why is it that TCS is being assigned such a high growth multiple. So this is the first key utility of looking at the PE ratio. The second key utility of PE multiple is that sometimes you witness really odd PE multiples and you must get suspicious about such companies. A classic case in point is Nykaa, and here if you take a look at the stock PE, it is trading at 1091. Now this is some crazy number. Now unless you believe that Nykaa is going to exhibit such impressive growth that it is going to break all records in the world, then probably this valuation makes sense. But to cut the long story short, you don't need to be a mathematician and a financial genius to understand that 1091 PE multiple has any sense from a valuation perspective. Let me quickly clarify. I feel that Nykaa's business is very good, but unfortunately, as per my understanding, it looks like an overvalued stock. So I have stayed away from it, not because there is something fundamental off in the business, just because of the fact that the valuations are so rich. So this is the second utility of PE. Now comes the third utility or third clarification around PE, which is very important for us to understand, and it has to do with the nature of business. For example, if you take a look at cash flow based companies, then here the PE ratio is much more sensible to judge. A classic case in point is something like Hindustan Unilever or something like Nestle or something like Pidilite or something like Procter & Gamble. Why? Because here the business growth is very, very predictable. So this earning thing is much more predictable. So therefore the PE ratios are somewhat logically assigned, so to say. But on the flip side, if you are looking at tech companies, then estimating the growth of tech companies is really, really unpredictable and extremely hard to do. So PE multiples being assigned to technology companies are pretty much pointless, because it is almost impossible to define that how much money a particular tech company is going to make. Think about it this way, that for example, if Apple launches iPhone 15, if the sales of that iPhone 15 is good, then Apple is going to make crazy amount of money. That in turn depends on the brand value, the tech specifications that have been made, whether the technology will be a hit or a miss. So it is very, very hard to predict these things for a tech company. On the flip side, if you take a look at cash flow based businesses, that how much soap is HUL going to sell, estimating that demand is much easier, and therefore assigning this earning multiple is very easy in terms of cash flow based businesses, but not in tech businesses. Now, if you start talking about next gen tech like UiPath or Shopify and how their business model will evolve, so PE just becomes like a khayali pulao, right? So there is no head or leg to that particular number when it comes to estimating the business model of these tech-based companies. So then comes the obvious question that, okay, if PE is so bad, then what is it that we should be doing rather? Is there a number, specific number that we can boil our buying and selling decision to? So unfortunately, no, you can't automate the stock buying and stock selling process. If it was that simple that, hey, PE more than 30, go sell it, PE less than 30, go buy it, then there would be no analysis required in the stock market. But that is not how it works. A better measure is to look at these three specific factors. Number one, take a look at the macro growth. For example, India is a growing country. It is likely to grow faster compared to something like the US. And if India grows faster than estimates, then there will be an entire re-rating of PE of India itself. So that is the first key thing that you must estimate whether India is going to grow or not grow. Second key thing, whichever industry stocks that you are trying to pick, you must do a sectoral growth analysis also, that if that sector is growing or if that industry is growing, then it's a sunrise industry and it will be assigned a higher PE multiple. Third and finally, is the firm in which you are investing, how its profitability is growing, not just simply revenues. So if the profitability is growing, for example, if it is launching more products, if it is expanding across new geographies, if it is underdoing a lot of R&D effectively, these are all signs that the higher PE multiple or PE expansion of this particular stock is going to undertake. As long as these three things keep on happening, even a very high PE stock will continue to give you excellent growth. No problem in terms of stock prices there. So which brings us to a very short discussion that what are three industries where I feel a high PE will be assigned in the future and three industries where I feel PE contraction will happen. So let me very briefly give you a very quick commentary there. So three industries where I feel PE expansion is likely to happen in India are, number one, AMC and insurance businesses. AMCs already have very high profitability. You can go and check the balance sheet, look at the operating profit margins of AMC companies. You will be surprised by the profitability of AMC companies. So I'm quite bullish about these companies. Same goes for insurance, that since the insurance industry as a whole is growing, I'm bullish about the insurance sector in India as well, because even their profitability will improve with scale. Second key industry, I assume that if there are certain crypto based organizations in India, then I would invest in them or do proxy investing in them, because crypto as a whole will continue to grow despite regulations in India. Why is that the case? For that, you will have to watch my crypto videos. I will not explain extensively here, but to cut the entire discussion short on cryptos, the entire asset class is growing. So crypto as an asset class is growing as long as the entire asset class grows, and it's a world dominated asset class. So of course, companies in India that are benefiting from this crypto ecosystem, they will also grow quite aggressively. Maybe in the future, 5, 10, 15, 20 years, there might be companies like WazirX that might get listed on the Indian exchanges as well. You will say, Akshat, you have gone crazy. No, take a look at Coinbase, which is a US-based listed crypto exchange already trading in the US economy. So similar situation can play out in India 100%. Third and finally, I feel that banks still have some steam left. So I would assign a higher PE multiple for something like banks. So I'm quite bullish about these three specific sectors. I do feel that as more and more people start using more banking products, banks will become even more profitable and their profitability will increase, not because just about the volumes growth, but because of the number of products that banks are selling. Now, three industries where I feel that PE contraction will happen. Number one, conventional automobiles. It's almost given that conventional automobiles in the coming few decades will definitely shift to EVs. Now, as the price point of EV comes down, conventional automobile, their PE contraction will happen and they will lose a lot of market share. Now, if there are companies, for example, Maruti, if it is able to successfully migrate to an EV based ecosystem, then of course, its PE multiple will stay intact. On the flip side, if these companies do not improve, if they continue to stay in conventional automotive space, they will struggle and PE contraction will 100% happen. Second key industry is the PSU bank. I feel that PE multiple of PSU banks will keep on shrinking. Very easy to understand why, because they are getting lesser and lesser support from the government over a period of time. Previously, a lot of budget was earmarked to support and subsidize the inefficiencies of PSU banks. Now that thing is going away. Unfortunately, PSU banks, when compared to private banks, are not that efficient in terms of gaining or building their business also. So over time, over the next 2-3 decades, PSU banks are going to suffer even more and it will definitely lead to PE contraction. Third and finally, I feel that airlines industry is also going to shrink. For the simple fact that now we are moving towards a world where any industry that can be taxed super high, it will keep on fluctuating in terms of profitability. Now, airlines is one of the highest taxed industries and it is completely under the control of the government, so to say. So they decide airport charges, they decide hangar charges, they decide air traffic volume, they decide a bunch of different things, and it becomes really difficult for airlines companies to sustainably stay profitable. So therefore, I don't see any major airlines coming in India and accelerating its profitability over a sustained period of time. Having given this commentary, I want to put a brief disclaimer that these are my opinions. This is how I see the world progressing. You don't necessarily need to agree with me there. Each of us can have our own viewpoints, but the important message I want to drive home is use this PE framework as an indicator to do your own analysis. PE standalone is a pointless ratio. You will not be able to decipher whether a stock is undervalued or overvalued from that particular perspective. A better way of approaching the undervalued or overvalued nature of any stock is use PE in conjunction with the business development framework that I just helped you understand. I hope you like the video. Please press the like button and I will see you tomorrow.